Financial headlines often amplify dramatic predictions about markets, institutions, and commodities. But behind the noise, responsible analysis requires evidence, context, and careful interpretation. Today, rather than focusing on speculation, we'll examine the economics of the silver market, the role of large financial institutions like JPMORGAN, and how legal oversight and market regulation shape public understanding. Understanding institutional commodity positions. Large financial institutions participate in commodity markets for multiple reasons: hedging client exposure, providing liquidity, facilitating trading, and managing risk portfolios. Banks such as JPMorgan have historically been active in metals markets including silver, through futures contracts, derivatives, and physical holdings. Importantly, these positions are regulated by agencies such as the U.S. Commodity Futures Trading Commission. Public filings, enforcement actions, and regulatory disclosures help ensure transparency. While concerns about market concentration occasionally arise, generally focus on whether trading practices comply with market integrity rules, rather than on speculative price forecasts. The economics of silver pricing. Silver prices are influenced by several measurable factors: industrial demand, especially electronics, solar energy, and medical applications; investment demand through ETFs, coins, and bullion; interest rates, inflation expectations, and currency strength; supply constraints from mining output and recycling. Predictions of extreme price moves, whether upward or downward, often reflect market sentiment more than confirmed economic fundamentals. Historically, commodity markets tend to adjust gradually unless major structural disruptions occur. Legal and regulatory context. There have been past legal cases involving precious metals across multiple institutions, including fines for misconduct such as spoofing, placing orders with intent to cancel to influence prices. These enforcement actions illustrate how financial markets are continuously monitored. However, legal settlements or regulatory actions do not necessarily imply systemic institutional failure. They typically result in fines, compliance reforms, and stronger oversight rather than collapse scenarios. Public narratives vs. evidence. Financial commentary sometimes blends legitimate analysis with dramatic storytelling. Claims about imminent institutional crisis or extraordinary price surges should always be evaluated against verified regulatory filings, peer-reviewed economic analysis, official market data, historical precedent. Critical thinking is essential because markets are complex systems influenced by policy decisions, global trade conditions, and investor psychology, not single events or predictions. Broader economic implications. From a policy perspective, discussions about commodity markets highlight several ongoing issues: market transparency and disclosure standards, financial institution accountability, industrial resource planning for energy transitions, investor education about risk and volatility. These factors matter far more for long-term economic stability than short speculative headlines. Large commodity positions by financial institutions. JPMorgan, along with other major banks, participates in silver futures and derivative markets as part of its risk management, trading, and client services. These positions are reported periodically to regulators through required filings, such as the CFTC's Commitments of Traders Report, ensuring transparency in institutional market activity. Regulatory oversight and compliance. Commodity trading by banks falls under U.S. federal regulations, including the Commodity Exchange Act. Regulators monitor market conduct to prevent manipulation, maintain market integrity, and ensure compliance with reporting requirements. Past enforcement actions in commodities demonstrate a framework for accountability, though they do not automatically indicate systemic institutional risk. Economic factors influencing silver prices. Silver prices are influenced by industrial demand, investment demand, and macroeconomic conditions such as inflation, interest rates, and currency fluctuations. These measurable factors provide a grounded context for price movements rather than isolated speculation. Institutional risk vs. market perception. Headlines sometimes suggest dramatic institutional exposure or potential losses. In reality, banks manage these exposures through hedging strategies, capital reserves, and regulatory oversight. Analytical evaluation focuses on verified financial statements and regulatory reports rather than narrative-driven predictions. Broader policy and market implications. Discussions about large bank positions in commodities highlight the importance of transparent financial reporting and market disclosure, regulatory vigilance to maintain fair and orderly markets, public understanding of how institutional trading intersects with economic stability. These issues are central to ongoing debates in economic policy, investor protection, and public financial literacy. Large financial institutions like JPMorgan play a significant role in global commodity markets, including silver, through both physical holdings and derivatives trading. These positions are not taken lightly, they are part of structured strategies designed to manage risk, provide market liquidity, and serve the needs of institutional clients. Banks use futures contracts, options, and swaps to hedge against price fluctuations or to facilitate client transactions. This level of engagement can influence market depth and trading volumes, but it operates within a framework of regulatory oversight and disclosure requirements that aim to maintain market transparency. Participation in the silver market by a major bank is often interpreted as a reflection of broader economic strategies rather than isolated risk-taking. Silver, unlike many other commodities, has both industrial and investment demand, which means that institutional positions can be linked to multiple market objectives. For example, a bank may hold positions to balance client portfolios in exchange-traded funds, support hedging operations for mining or manufacturing clients, or maintain liquidity in derivatives markets where price discovery occurs. These activities, while substantial in scale, are part of standard financial operations that are documented and reported to regulatory agencies. Regulatory filings, such as the Commodity Futures Trading Commission's commitments of traders' reports, provide a public window into these positions. These reports show the size and type of positions held by commercial and non-commercial traders, offering analysts and policymakers measurable data to understand market concentration and potential exposure. While media narratives often frame large positions as risky or speculative, the data suggests that institutional activity is largely structured, monitored, and subject to risk management protocols. It is also worth noting that banks maintain internal limits and oversight procedures to prevent excessive exposure that could threaten solvency or systemic stability. The presence of large institutional positions can raise important questions about market influence and concentration. How do these positions affect price formation? What role do they play in providing liquidity versus creating potential imbalances? By examining publicly available data and understanding the economic rationale behind institutional participation, observers can separate measured analysis from sensationalized interpretations. This approach emphasizes evidence over conjecture and highlights the importance of transparency, oversight, and informed discourse in evaluating the role of major banks in commodity markets like silver. Commodity trading by large financial institutions operates within a highly regulated environment designed to maintain fair and orderly markets. In the United States, the Commodity Futures Trading Commission, or CFTC, is the primary federal agency overseeing trading in futures, options, and certain derivatives, including those linked to silver. These regulations are intended to prevent market manipulation, promote transparency, and protect both investors and the broader economy. By examining the framework that governs institutional participation, we can better understand the checks and balances that influence market behavior. Regulatory oversight encompasses several dimensions. First, banks and other market participants are required to report large positions, often through filings such as the Commitments of Traders Report. These filings provide detailed data on the size, direction, and classification of positions held by commercial and non-commercial traders. Analysts, policymakers, and market participants rely on this information to gauge concentration, exposure, and potential systemic risk. By making these reports publicly available, regulators help ensure that market developments are interpretable and measurable rather than speculative. Enforcement is another critical aspect of regulation. Over the past decades, the CFTC and other regulatory bodies have pursued cases involving improper trading practices, such as spoofing or misrepresentation, which can distort prices or trading signals. These actions typically result in fines, compliance reforms, or enhanced monitoring procedures. While such enforcement receives media attention, it is important to interpret these events within the broader context. Regulatory actions are intended to reinforce market integrity rather than signal institutional failure. They demonstrate that a structured system exists to address irregularities and protect market participants. Questions about the influence of large banks on commodity arise in public discourse. How much can one institution's trading affect market dynamics? Regulatory frameworks provide part of the answer, as limits on position size, reporting requirements, and market surveillance reduce the likelihood of unchecked market influence. Furthermore, banks employ internal risk management strategies, stress testing, and compliance protocols to ensure that their trading activity does not pose undue systemic risk. Understanding the regulatory environment also highlights the interplay between market transparency and public confidence. Clear rules, regular reporting, and enforcement create conditions for predictable and fair markets, which are essential for industrial users, investors, and policymakers alike. By focusing on these measurable aspects, rather than headlines or speculation, it becomes possible to appreciate the structured and accountable nature of institutional commodity trading. Silver occupies a unique position in global markets because it functions as both an industrial commodity and an investment asset. Its pricing is influenced by measurable economic factors that reflect supply and demand dynamics, macroeconomic conditions, and investor behavior. Industrial demand plays a particularly significant role, as silver is widely used in electronics, photovoltaics for solar energy, medical devices, and other technological applications. Changes in production levels, manufacturing growth, or technological innovation can shift demand patterns, affecting how institutions, industrial users, and investors approach the market. Investment demand also shapes silver prices. Exchange-traded funds, bars, and other forms of bullion provide investors with exposure to silver without requiring direct industrial use. Fluctuations in interest rates, inflation expectations, and currency strength further affect investor behavior. For instance, when real interest rates are low, precious metals often become relatively more attractive as a store of value, while higher rates may reduce investment demand in favor of fixed income assets. Understanding these relationships allows analysts to interpret price movements based on observable, economically grounded factors rather than relying on speculation or anecdotal reports. Supply considerations are equally important. Silver is extracted primarily through mining operations, and output can be influenced by geological, technological, and environmental factors. Recycled silver from industrial scrap or consumer products also contributes to market supply, providing a counterbalance to mining output. Variations in production and recycling levels can affect price stability, highlighting the interconnectedness of physical supply chains, industrial consumption, and investment demand. Price movements in silver are also shaped by global macroeconomic trends. Currency fluctuations, trade policies, and geopolitical events can alter both industrial costs and investment incentives. For example, changes in the US dollar, as the primary currency for silver trading, can influence global demand and pricing. Similarly, shifts in energy policy, technology adoption, or industrial standards can create measurable impacts on the market. These factors illustrate that silver markets are influenced by a combination of predictable economic fundamentals rather than isolated speculation. Questions about volatility or rapid price movements often arise in public discourse, but the broader context reveals that silver markets operate within structured economic frameworks. By examining industrial demand, investment patterns, supply dynamics, and macroeconomic conditions, observers can approach market developments with an analytical lens. This approach emphasizes evidence-based evaluation, demonstrating how commodity prices reflect the interaction of measurable factors, rather than being driven solely by narrative or conjecture. Public discussion about large financial institutions often raises questions about risk and influence, particularly when it comes to commodity markets like silver. Headlines may highlight sizable positions held by banks and imply that these positions could destabilize markets. While it is true that institutions maintain large holdings, interpreting this information requires careful analysis of the economic and regulatory context. Banks employ sophisticated risk management systems that include hedging strategies, capital reserves, and internal limits designed to prevent exposure that could threaten their solvency or broader market stability. This structured approach distinguishes measured risk, taking from uncontrolled speculation. Institutional risk must also be considered relative to market scale. Global silver markets involve both physical and derivative components, with liquidity spread across exchanges, industrial users, and retail investors. Large positions can influence short-term price dynamics, but they operate within a network of competing market forces. Regulatory oversight, position limits, and reporting requirements further constrain potential market impact. By understanding the framework within which banks operate, analysts can assess risk with reference to measurable exposure, rather than relying on sensationalized narratives. Perception often diverges from reality because financial markets are complex and not always immediately transparent to the public. Media coverage may emphasize dramatic swings or potential losses, without detailing the mechanisms banks use to manage them. Stress testing, scenario analysis, and risk-adjusted capital requirements are standard tools that institutions apply to ensure resilience against price volatility. These measures, alongside regulatory monitoring, reduce the likelihood that a single bank's positions could trigger systemic instability. This context raises important questions for market observers. How should large institutional positions be interpreted, and what metrics provide a realistic assessment of risk? Commitments of traders' reports, regulatory filings, and financial disclosures allow analysts to track position size, market concentration, and exposure levels. By focusing on these data points, Observers can separate market realities from narrative-driven speculation. Understanding institutional risk in this way also highlights the role of transparency and accountability. It demonstrates that large positions are not inherently destabilizing when managed responsibly and monitored under regulatory standards. This perspective encourages critical thinking about financial reporting, market dynamics, and investor interpretation. Rather than reacting to dramatic headlines, informed analysis relies on public data, historical precedent, and economic reasoning to evaluate the true significance of institutional activity in commodity markets. Discussions of large bank positions in commodities like silver often highlight broader questions about policy, market structure, and economic governance. Financial markets do not operate in isolation. They are shaped by regulatory frameworks, transparency standards, and institutional accountability. Understanding how these elements interact is essential for evaluating the implications of sizable institutional activity. For example, clear reporting requirements and public disclosure of positions allow policymakers, investors, and analysts to monitor potential market concentration and ensure that no single participant exerts disproportionate influence over prices. Regulatory oversight plays a key role in maintaining market confidence. Agencies such as the Commodity Futures Trading Commission in the United States set rules for position limits, reporting, and market conduct, while also enforcing compliance through investigations and penalties when irregularities occur. These measures are designed to protect market integrity and prevent systemic disruptions, illustrating the ways in which policy and regulation intersect with institutional activity. They also provide a mechanism for continuous evaluation of market health, enabling adjustments to rules and monitoring practices in response to evolving economic conditions. Transparency and accountability extend beyond regulatory filings. Banks and other market participants implement internal controls, risk management procedures, and scenario planning to limit exposure to extreme market movements. These operational safeguards complement public policy frameworks, creating a layered system that balances opportunity with oversight. From an economic perspective, this structure reinforces stability by ensuring that the actions of large institutions are both visible and constrained. The public discourse around commodities can also raise questions about resource allocation and industrial planning. Silver, for example, has both industrial and investment value, meaning that fluctuations in supply, demand, or price can influence sectors ranging from technology to energy to consumer goods. Policymakers and market participants benefit from analytical frameworks that consider these broader effects, rather than reacting solely to short-term price movements or media narratives. This perspective encourages critical engagement with financial news and market analysis. It invites questions such as how regulatory structures can evolve to meet changing market conditions, how transparency initiatives affect investor confidence, and how industry and investment demand intersect to shape prices. By emphasizing evidence, public reporting, and policy context, observers can better understand the role of large institutions in commodities markets, while remaining grounded in factual, measurable information. This approach reinforces the importance of informed analysis and responsible engagement with financial systems, rather than reliance on dramatic headlines or speculation. Public narratives around commodities often shape perception as much as actual market developments. Media coverage of financial institutions, precious metals, or large trading positions can emphasize dramatic events or potential losses, creating a sense of urgency or concern among investors and the general public. While reporting is essential for transparency, it raises important questions. How do these narratives influence market behavior, and how can observers separate evidence from perception? Understanding the difference between measured analysis and narrative framing is critical for responsible engagement with financial markets. Commodity markets operate within structured frameworks governed by law, economic principles, and institutional practices. Headlines that highlight extreme price movements or suggest institutional doom rarely capture the full picture. Analysts rely on data from public filings, regulatory disclosures, and market statistics to assess actual exposure, liquidity, and potential systemic risk. This evidence-based approach provides a more accurate understanding of market dynamics than anecdotal or speculative accounts. By examining verified data, observers can evaluate whether large positions influence market trends or are part of standard hedging, trading, and risk management strategies. Media framing also intersects with public policy. Policymakers, regulators, and financial institutions monitor actual market activity and public perception because sentiment can affect market stability. For example, widespread alarm or misinterpretation of institutional position to contribute to unnecessary volatility, even when economic fundamentals remain sound. This dynamic underscores the importance of clear communication from both regulatory agencies and market participants to ensure that public understanding aligns with observable realities. Moreover, public engagement with financial news offers an opportunity to explore broader economic and legal structures. Discussions of market concentration, regulatory oversight, and institutional accountability can be grounded in factual analysis rather than fear or speculation. Questions about transparency, risk management, and market efficiency encourage critical thinking about how economies function and how policy frameworks are applied. Observers are better equipped to understand the consequences of large-scale trading, the safeguards in place, and the measurable factors that influence commodity pricing. By maintaining focus on evidence, regulation, and economic context, the conversation shifts from sensationalism to informed analysis. Understanding the relationship between market narratives and factual data empowers both individual investors and the broader public to interpret developments responsibly. This approach fosters critical engagement with financial information while emphasizing the structures and policies that ensure stability in complex markets like silver and other commodities. As we reflect on the dynamics of commodity markets, institutional participation, and regulatory oversight, a clear pattern emerges. Market outcomes are shaped by structured economic forces, measurable supply and demand factors, and layers of transparency and accountability. Large positions, whether held by banks, investors, or industrial users, operate within frameworks designed to manage risk and maintain stability. Headlines may highlight dramatic events or potential exposure, but careful analysis reminds us that understanding requires data, context, and historical precedent rather than speculation. Regulatory structures, reporting requirements, and risk management protocols are not abstract concepts. They are tangible mechanisms that shape market behavior, protect participants, and support confidence in financial systems. Similarly, silver and other commodities reflect the intersection of industrial demand, investment patterns, and macroeconomic conditions. Observing these factors through the lens of evidence-based analysis allows us to separate narrative from measurable reality. The broader takeaway is a call for critical thinking. By examining verified information, exploring the economic and legal context, and assessing institutional behavior with rigor, we can better understand how markets function and why certain movements occur. This approach promotes informed engagement, encourages analytical inquiry, and underscores the value of transparency and accountability in complex financial systems. In the end, understanding markets is less about predicting dramatic outcomes and more about interpreting the underlying structures that govern them. Observing these systems with attention, curiosity, and disciplined reasoning equips us to engage responsibly as investors, analysts, or informed citizens, while appreciating the multifaceted forces that shape economic realities.